Okay, now we're going to go through some more journal entries. These ones have some additional accounts that you haven't covered before, but the good news is the accounts still fall under all the same categories that they did before. All accounts either fall under assets, liabilities, stockholders' equity, revenues, or expenses. So as long as you know the rules of debits and credits, it still goes the same. I put my little steps to journalizing out here to the side just so we can, if you prefer that, that's great. If you can move through it faster than that, that's fine too. I find for the first few chapters, most students find it pretty useful, but you know, it's your call on how you want to do that. So I'm looking at December 1st transactions. It says Net Solutions paid a premium of $2,400 for an insurance policy for liability, theft, and fire. The policy covers a 1-year period. Okay, so first thing I want to talk about, there's a new account involved here. When I pay something ahead of time, so they paid this on December 1st, but it's for the next year, that means that they are owed insurance coverage. If they cancel this policy for some reason halfway through or 2 or 3 months in or whatever, they would get their money back, which means this doesn't become an expense until time passes, okay? So for now, what it is an asset, and we call it a prepaid expense. In this case, it's prepaid insurance. That's an asset because they are owed that coverage. If they do not receive that coverage, they should receive their money back. So what accounts are affected by the transaction? Well, first thing it says that they paid, so cash is affected. And then we have a new account called prepaid insurance. Okay, that is also affected by this. Do the accounts increase or decrease? Well, I paid someone money, so cash decreases, and I am owed insurance after this that I was not owed before I paid this money. So prepaid insurance increases. Okay, what type of accounts are they? Cash, I hope we know by this point, is an asset. And prepaid insurance is a new one, but for anything that someone owes to us, okay, so something that we are owed or that we have rights to, somebody owes us this insurance coverage. Prepaid insurance is also an asset because they owe us the insurance that we just paid for. How much are we adjusting by? Well, $2,400 because that's how much we paid, and that's how much the insurance is worth on our books. And then now we just need to apply the rules of debits and credits and journalize it. Well, we have 2 assets here, and I'm not going to pull it back on the other screen, but assets are increased with a debit and decreased with a credit. I am increasing prepaid insurance. It is an asset. So I am going to debit prepaid insurance for $2,400, and I am going to credit. I'm going to credit cash because I'm decreasing cash for $2,400. Okay, next transaction. It says Net Solutions paid rent for December for $800. The company from which Net Solutions is renting the office space now requires payment at the first of each month rather than the end of each month. So what accounts are affected? Well, I'm not going to type them all out this time, but the accounts that are affected in this case are cash and rent expense, because I'm paying for rent. Okay, so cash and rent expense. Do they increase or decrease? Cash, we are paying cash, so cash goes down. And rent expense, we are incurring that expense, so rent expense goes up. What type of accounts are they? Cash is an asset account. Rent expense is an expense account. How much are we adjusting by? The $800 that's given. And then apply the rules of debit and credit. So we have an increase in rent expense and an increase in expense account. According to the rules of debit and credit, is increased expense accounts are increased with a debit, and asset accounts are decreased with a credit. And cash is an asset account. Okay, another new type of transaction we haven't talked about yet. So it says on December 1st, Net Solutions received an offer from a local retailer to rent the land purchased on November 5th. The retailer plans to use the land as a parking lot for its employees and customers. Net Solutions agreed to rent the land to the retailer for 3 months with the rent payable in advance. So they received $360. Net Solutions received $360 for 3 months rent beginning December 1st. Okay, so one side of this should be pretty easy. They received cash of $360, so we need to increase cash. Cash is an asset, so it is increased with a debit. for $360. But here's the issue. It's kind of the other side of that prepaid insurance question we just talked about. I owe them 3 months time on this land because they paid me for it. If for any reason I say, oh no, I want to start building on it and you can't use it anymore, I should give them their money back. So while I don't owe them money right now, what I owe them is time. If for any reason that time doesn't happen, then I would owe them money back. So effectively, I have not yet earned this rent until time passes. So after month 1, I've earned 1 month of it. And really, you could do it daily if you wanted to. Usually we go month to month. After month 1, I've earned 1/3 of this. After month 2, I've earned 2/3 of it. After month 3, I've earned it all. So they paid 3 months in advance. So for now, I need to book a liability showing that I owe them this time on the land that they rented from us. So we have a new account called unearned rent. And what it will become once it is earned is earned rent or rent revenue. Unearned rent is a liability account. So if what accounts are affected, we're talking cash and unearned rent. They increase or decrease. Cash increases. Unearned rent increases. It's a liability that I owe. Increasing liability of what I owe. What type of accounts are they? Cash is an asset. Unearned rent is a liability. How much are we adjusting by? 360. And applying the rules of debits and credits. So they both went up. Cash went up. We debit an asset account to increase it. Unearned rent is a liability account. I credit a liability account. Remember too, my debits and credits must always balance. And you see that they do. A balance, a balance, a balance. Okay. December 4th. I kind of skipped that one, it looks like, on my dates here. It's okay. December 4th. It says that Net Solutions purchased office equipment on account from Executive Supply Company for $1,800. So a couple important things here. Number 1, I purchased office equipment. Office equipment is an asset, okay? So it's something that I received. So accounts that are affected, office equipment is one. The other side, since this is on account, that means that I did not pay cash for it. Instead, I said I will pay you later. They don't tell us what the terms are, but I'm going to pay you in 10 days, 20 days, 30 days, 60 days, whatever it is. But I set up terms with this company to not pay now and pay them later. So that means that I owe them money. So the other part that I have an asset of office equipment, but I also have a liability of accounts payable. I owe money. Did they increase or decrease? Well, I received office equipment, so office equipment went up. I'll go ahead and put these two here. Office equipment is an asset. It increased. It's a type of account's an asset. It increased. It increased by $1,800. And we increased an asset with a debit. And then we have a liability, accounts payable. Okay. Liability accounts, this one also went up, but it's a liability account and it increases with a credits. Again, my debits and credits balance. I'm going to skip over a couple of these that I think that you should probably know already from prior in the chapter. The miscellaneous expense, the accounts payable, I think we've handled that. We'll do that accounts payable one on December 11th. So December 11th, it says Net Solutions paid creditors $400. What accounts are affected? Well, I paid my creditors, so accounts payable is a liability, and I also paid them, which means cash is affected. They increase or decrease, well, I paid someone money out of my pocket, so my cash goes down. My liability also goes down because accounts payable, I owe less after this transaction than what I did before. What are the account types? Cash is an asset. Accounts payable is a liability. So accounts payable and cash. So cash is a liability, or sorry, accounts payable is a liability and it goes down. It is decreased with a debit. It says I paid $400. Cash is an asset. It also goes down, but it is decreased with a credit. So $400 there. I'm going to skip over the fees or the wages expense and the fees earned. Okay, another one we haven't talked about from the other side on December 16th. On December 16th, it says that fees earned on account was $1,750 for the first half of December. So this on account phrase came up again. On account always means that cash did not exchange hands right then and there. So instead, that means that they owe us later. But this isn't me owing someone else. Someone owes us. So I went out and performed work for a company, for an organization of some kind, and then I said, hey, you can pay me later in 10 days, 20 days, 30 days, whatever it is. So this is a new account, but I am owed money, so we'll go through this. The accounts that are affected, the first one is accounts receivable. Accounts receivable is money that people owe me. Okay, so it is an asset because I am owed money from someone else. They legally owe me money. What did I do? Well, I earned this money. I have a revenue, and in this case, that revenue account is called fees earned. So did they increase or decrease? They both increased. I am owed more money than what I was before this transaction, so accounts receivable goes up, and I earned more money than before this transaction, so fees earned goes up. What type of accounts are they? Accounts receivable is an asset account. Fees earned is a revenue account. How much are they adjusting by? $17.50 in this case, and then applying the rules of debits and credits. So both of them increase. Accounts receivable, I increase accounts receivable with a debit because it's an asset, $17.50, and I increase fees earned with a credit, $17.50. I put that on the wrong date on accident here. December 16th transaction. Okay, I'm gonna skip over. Actually, I want to do the December 21st transaction. So December 21st says Net Solutions received $650 from customers in payments on their account. So read this carefully and know that it says that this is payment for their accounts. This is not payment for new work that they did. Instead, this is work that they've already done, and they are being paid for it in the future. So I'm basically, if you think of this last transaction we just did, the accounts receivable transaction, now we're getting paid for some of this, whereas we hadn't been paid yet before. So why I say that repeatedly is because what most students want to do when they see this, they say receive cash of $650 for payment of their accounts, they want to record it in revenue, but we do not record this in revenue because we have already recorded it in revenue when we earned it in the first place. We recorded it in revenue up here. I can't record it as revenue twice. So the accounts that are affected, number one is accounts receivable. Think that before this transaction we were owed $17.50, and after this transaction we were owed less than that because some of our customers paid us. So we're no longer owed all of our money that we were owed before. Some of it got paid down. We're owed less than what we were prior to this. The other account that's affected because I received cash is cash. So accounts receivable, abbreviated as AR here, goes down because I'm not owed as much money as I was before this. Cash goes up. It's an increase. What type of accounts are they? They are both assets. Accounts receivable, money we were owed as an asset. Cash is also an asset. How much are they being adjusted by? In this case, $650. And now it's applying the rules of debits and credits. So cash goes up by $650, and accounts receivable goes down by $650. I do not record, that's on the wrong date again, I do not record fees earned there because they're paying me for fees that I've already earned prior to this. So I cannot record that in fees earned. All right. Several more transactions that we've really talked about before. So I think that's it for this video. There's more transactions than what I went over, but I went over what I would consider to be the new transactions, the ones that were different from the videos we've done before. The rest of them, the expenses, the dividends, those types of things we've talked about in the past, so I don't think I need to cover a second time. But as always, if you have questions, email me, let me know if you need anything.